Let's talk about high-yield ETFs. They sound exciting, don't they? Who doesn't love the idea of earning 10%, 15%, or even 20% yields every year? It almost sounds too good to be true, and in many cases it is. But the story doesn't end there. Because in today's income-hungry world, high-yield ETFs have carved out a spot in many portfolios. So the question is, are these ETFs hidden gems or ticking time bombs? In this deep dive, we're going to unravel everything you need to know about high-yield ETFs, how they work, what risks they carry, which ones are trending right now, and how to determine whether they actually fit into a long-term portfolio. Why high-yield ETFs are so popular right now, let's start with the elephant in the room, interest rates. After years of near zero interest rates, central banks across the globe started aggressively hiking them in 2022 and 2023. As a result, traditional income sources like savings accounts and bonds became more attractive again. But with inflation biting into purchasing power, many investors wanted even more income. Enter high-yield ETFs. These ETFs are designed to pay out eye-catching monthly or quarterly dividends by investing in a variety of strategies, some of which are perfectly reasonable and others a bit more complex, if not outright speculative. That's where things get interesting. The methods behind the madness high-yield ETFs don't all operate the same way. In fact, they fall into several different categories. 1. Covered call ETFs. These ETFs generate income by selling call options on top of their existing holdings. The income comes from the option premiums, not from the stock's dividends. Popular examples include QYLD, tracks the NASDAQ 100 and writes at-the-money calls on it. XYLD, similar strategy on the S&P 500. RYLD, focuses on the Russell 2000. These ETFs often pay yields north of 10%, but here's the catch. They sacrifice most of the market's upside in exchange for those consistent premiums. Over time, especially in bull markets, this can lead to underperformance relative to the index. 2. Leveraged income ETFs. Some high-yield ETFs use leverage to amplify income, borrowing money or using derivatives to buy more income-producing assets than they could otherwise afford. This increases both the potential yield and the risk. One example is YYY. The Amplify High Income ETF holds a basket of closed-end funds, many of which are already leveraged themselves. This kind of structure can be incredibly sensitive to interest rate spikes, NAV discounts, and market drawdowns. 3. Junk bond ETFs. Junk bonds, technically known as high-yield corporate bonds, are issued by companies with lower credit ratings. They pay higher interest because the risk of default is greater. ETFs like J&K and HYG are leaders in this space. These can be a more straightforward way to get income, but again, risk is high. During recessions or financial stress, junk bonds are often the first to suffer. 4. Dividend trap ETFs. Some ETFs chase high dividend-paying stocks, regardless of whether those payouts are sustainable. This can lead to portfolios filled with companies in financial distress or cyclical sectors under pressure. Think about a utility company paying a 10% dividend, not because it's growing, but because its stock has crashed and the dividend hasn't been cut yet. So while these ETFs look like they're paying steady income, that yield might be a red flag rather than a reward. Let's be honest. When most investors see a double-digit yield, they immediately think free money. But income doesn't come without strings attached. Here are the key risks you must understand. 1. Capital erosion. This is the big one. Many high-yield ETFs return a portion of your own capital back to you as distributions, especially when performance lags. That means you're not just earning income, you're eating into your principal. A fund might pay you 15% in dividends, but if the share price drops by 20% that same year, your net return is negative. This is especially common with funds like QYLD or YYY, where the underlying asset base slowly deteriorates. 2. NAV discounts. ETFs holding closed-end funds, CEFs, often trade below their net asset value. This can amplify losses in down markets and cause the yield to look artificially high. 3. Interest rate sensitivity. Rising rates don't just hurt bond prices. They can also affect income-focused equities, REITs, and leveraged ETFs. If the cost of borrowing goes up, the returns on leveraged strategies drop. 4. Dividend cuts. If the underlying companies or funds reduce their payouts, the ETF will follow. This can be a slow burn. 1 month your income is $100, and a year later it's $60 with no explanation. One of the biggest selling points of high-yield ETFs is the monthly income. Investors love the predictability. It feels like getting a paycheck from your portfolio. And fund managers know this, so they lean into it. But this can be deceptive. Monthly distributions don't always mean monthly profits. In fact, in many cases, the payout is smoothed out to appear consistent, even when returns are volatile. Some ETFs even dip into short-term capital gains or return of capital just to maintain those monthly checks. It looks great on a yield chart, but again, it's not always sustainable. Let's look at a real-world example. YieldMax is famous for paying a yield between 10%, 12% annually. But since its inception, it has underperformed the NASDAQ 100 by a massive margin, while QQQ delivered around 15%, 17% per year over the last decade. YieldMax hovered closer to 5%, 6% total returns. That's a huge difference, especially over long time frames. So the critical takeaway, yield should never be viewed in isolation. You want total return, which includes both income and price appreciation. If your ETF pays you 12% but loses 8% in capital value, your actual return is only 4%, and with more risk than a broad market index. That said, not all high-yield ETFs are inherently bad. Here are a few scenarios where they might fit. Retirees needing income. If you need monthly cash flow and understand the risks, a covered call ETF could provide a smoother experience than constantly selling off assets. Side pocket exposure. You might allocate a small portion, say 5%, 10% of your portfolio to high-yield ETFs for tactical income without relying on them for long-term growth. Tax-advantaged accounts. Using these ETFs in IRAs or Roth IRAs can be a smart way to avoid tax headaches from frequent payouts. Market-neutral strategy. Some investors use covered call ETFs during periods of flat or range-bound markets to extract income while accepting muted gains. Here's a quick breakdown of some of the most popular high-yield ETFs on the market today and what makes them tick. YieldMax. Covered calls on NASDAQ 100. Great income, poor growth. JPY. JP Morgan Equity Premium Income. Blends covered calls with lower volatility stock picks. Better total return than YieldMax. YieldMax, but based on small caps. Higher volatility, similar strategy. YYY, a fund of closed-end funds with high yields and higher fees. STIE, tracks 100 of the highest dividend-paying stocks globally. Questionable quality filters. Each of these ETFs has strengths and weaknesses. Some prioritize income at the expense of growth. Others are complex, using leverage or derivatives that most retail investors don't fully understand. Final thoughts. Should you chase that yield? It all boils down to this. There's no such thing as free yield. Every percentage point of income comes with trade-offs, reduced upside, higher risk, or potential capital erosion. If you're considering high-yield ETFs, you need to dig beneath the surface. What's driving the income? Is it sustainable? What happens to your capital during a downturn? Can you live with flat or negative returns if the income keeps coming? High-yield ETFs can play a role in your portfolio, but they should never be the foundation. Like spicy sauce, a little goes a long way. So build a base with broad, diversified ETFs like VTI or SCHD. And if you must, layer in some income ETFs as a satellite, not the core. Because remember, in the long run, the best portfolios don't just pay you, they grow with you. Stay diversified. Stay informed. Stay informed.